Imagine waking up one day and realizing that your money is working for you, growing and multiplying, while you sleep. That's the magic of investing in stocks. But where do you start? Don't worry, because in this step-by-step guide, we're going to break down everything you need to know to start investing in stocks today. Stick around for some tips from the pros that will help you avoid rookie mistakes. Stock investing can seem complex, but with the right steps, anyone can do it. In fact, many successful investors like Warren Buffett, John Bogle, and Peter Lynch started right where you are, knowing nothing and building their knowledge one step at a time. Today, we're going to walk you through exactly how to start investing in stocks, even if you have zero experience. Kindly subscribe to this channel for more financial tips. Step 1. Learn the basics of stock investing. Before diving in, you need to understand what stocks are. Simply put, a stock is a share in a company. When you buy a stock, you're buying a small piece of that business. As Warren Buffett famously said, never invest in a business you cannot understand. Start by learning about the types of stocks, common stocks and preferred stocks, how dividends work, and why companies issue shares. This foundational knowledge will help you make informed decisions as you invest. Step 2. Set your investment goals. Before buying your first stock, ask yourself, why am I investing? Are you saving for retirement, a house, or just looking to grow your wealth over time? Your goal will influence how much risk you're willing to take. For beginners, it's essential to be realistic. As legendary investor Peter Lynch advises in One Up on Wall Street *, know what you own, and know why you own it. Understand your goals and how much risk you can handle. Step 3. Choose a stock brokerage account. You can't just go out and buy stocks like you buy groceries. You'll need a brokerage account to invest. There are many brokerage platforms like Robinhood, Fidelity, or TD Ameritrade that allow you to buy stocks online. Look for features like low fees, ease of use, and research tools to help you make the best decisions. Many platforms also offer fractional shares, meaning you don't need to buy a whole stock. You can invest as little as $5 or $10 in some stocks. This is a great way for beginners to get started with small amounts. Step 4. Understand different investment strategies. Once you've opened your brokerage account, it's time to decide how you want to invest. Will you buy individual stocks or opt for something more hands-off like index funds or ETFs? John Bogle, founder of Vanguard and the father of index investing, said it best: the winning formula for success in investing is owning the entire stock market through an index fund, and then doing nothing. Just stay the course. Index funds and ETFs offer broad diversification, which reduces risk, making them a smart choice for beginners. If you prefer to invest in individual stocks, make sure you understand each company you're investing in, don't just follow trends. As Warren Buffett advises, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Step 5. Start small and invest consistently. One of the biggest mistakes beginners make is thinking they need to have thousands of dollars to invest. The truth is, you can start with whatever you have, even if it's just $50 or $100. The key is to invest consistently over time. This strategy is called dollar cost averaging. You invest a fixed amount of money regularly, regardless of the stock price. Over time, you'll buy more shares when prices are low and fewer when prices are high, which smooths out your costs. As Dave Ramsey, financial expert and author of The Total Money Makeover *, says, building wealth is a marathon, not a sprint. Consistency is key. Step 6. Diversify your portfolio. Diversification is a critical strategy for reducing risk. Instead of putting all your money into one stock, spread it out across different sectors: technology, healthcare, consumer goods, and more. If one sector takes a hit, others might still perform well. Peter Lynch, who managed the famous Magellan Fund, advises, owning stocks is like having children, don't get involved with more than you can handle. In other words, don't overload your portfolio with too many stocks. Aim for a well-diversified mix that you can manage effectively. Step 7. Think long-term and avoid emotional decisions. Stock investing is not a get-rich-quick scheme. It's a long-term game. Markets can be volatile. One day they're up, the next they're down. But over time, historically, the market tends to rise. Benjamin Graham, considered the father of value investing, famously said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. This means that while short-term prices can be driven by emotions, long-term prices reflect a company's true value. To be a successful investor, avoid emotional decisions. Don't panic sell when the market dips. Stay the course and trust your long-term strategy. Step 8. Keep learning and stay informed. The best investors never stop learning. Books like The Intelligent Investor * by Benjamin Graham, Common Stocks and Uncommon Profits * by Philip Fisher, and The Little Book of Common Sense Investing * by John Bogle are great resources to build your knowledge. Additionally, follow the stock market news, earnings reports, and economic indicators. Staying informed will help you make better decisions and spot opportunities. Step 9. Monitor and adjust your portfolio. Once you've built a portfolio, it's important to review it regularly. Over time, some investments will perform better than others, and your goals may change. Make sure your portfolio still aligns with your risk tolerance and financial goals. But remember, as Warren Buffett advises, our favorite holding period is forever. Don't overreact to short-term market swings. Sometimes the best action is no action at all. Don't follow the crowd. Don't get caught up in hype. Just because everyone is talking about a stock doesn't mean it's a good investment. As Warren Buffett puts it, be fearful when others are greedy, and be greedy when others are fearful. Do your own research and make decisions based on your financial goals, not emotions or trends. Now you're ready to take the first steps toward becoming a stock investor. It might feel overwhelming at first, but with these steps, you're on the right path to growing your wealth. Have any questions or need more tips? Drop them in the comments below. Don't forget to like this video and subscribe for more in-depth guides on personal finance and investing.